What I'm about to reveal will make you question everything in your investment portfolio. After 2 decades leading JP Chase and overseeing trillions in global assets, I've seen patterns that most investors miss until it's too late, right? Now, for massive sectors or in free falling, I'm not talking about a market dip or temporary setback. I'm talking about complete extinction. Zero. Gone. Wiped out. And if you're invested in any of these, the clock is ticking louder than you. Think, this isn't fear-mongering, this is math. This is data from serving 100 million customers worldwide. This is what happens when you can see economic tsunamis forming years before they hit shore. These 4 sectors represent over $3 trillion in market value today. Within 5 to 10 years, most of that wealth will evaporate. The companies don't know they're dead yet, but the smart money does. And we've already started moving. Here's what we've been doing quietly at JP Morgan. Cutting exposure, restructuring, lending portfolios, advising institutional clients to exit. Not because of politics, not because of trends, because the fundamental economics have shifted permanently. What I'm sharing isn't speculation, it's analysis from massive datasets, adoption curves, regulatory shifts, and consumer behavior we track in real time. When you process millions of transactions daily across every industry, you see the future before it arrives. Today, I'm breaking down exactly which 4 sectors are doomed, why their death is unstoppable, and what you must do right now to protect your money before everyone else figures it out. Asterisk, sector number 1, traditional print, media, and publishing. But here's what you don't know. The collapse is happening at warp speed, not the slow decline people expect. I've financed these businesses for decades, and the numbers are absolutely brutal. Newspaper circulation collapsed 70% since 2000, still falling double digits annually. Magazine subscriptions down 40% and accelerating. But here's the real killer, the cost structure. Delivery systems, warehouse space. These costs worked when revenue was high. Now, they're financial anchors dragging companies underwater. We've analyzed every major print media company's financials. Same pattern everywhere. Revenues cratering, costs that can't shrink fast enough. Debt piling up, cash flow drying up. Then there's the AI factor. Automated. Why would advertisers pay premium rates for shrinking print audiences when digital platforms deliver bigger, targeted audiences at fraction of the cost? We've stopped financing new print media ventures. Period. We're helping existing clients pivot to digital only or facilitating mergers to salvage whatever brand value remains. It's finished, and it's happening faster than anyone expected. E-commerce didn't just hurt physical retail, it's executing it. And COVID wasn't the cause. It was the accelerant on a fire already burning. Consumer behavior has permanently shifted. People aren't going back. They discovered online shopping offers better prices, infinite selection, easy comparisons, and doorstep delivery. Once you experience that, why would you drive to a store, search for, deal with limited inventory, and carry stuff to your car? At JP Morgan, we process payments for retailers everywhere. Physical stores, declining 5 to 10% annually. This isn't temporary. Physical retail has crushing fixed costs. Leases, fixtures, inventory, staff, utilities, insurance, maintenance. Now that sales are falling, impossible to sustain. Look at department store numbers. Here's the acceleration factor. E-commerce logistics are now perfected. Amazon, Walmart, Target. They've built systems delivering most products in 24 to 48 hours at competitive prices. Same-day delivery is standard in major cities. Buy online, pick up in store, eliminated the last advantage physical retail had. Shopping malls, doubly doomed. Their model depends on anchor, department stores driving foot traffic. When the anchors, mall owners get stuck with massive properties that cost more to maintain than they generate. At JP Morgan, we've been cutting commercial real estate exposure to retail for years. We're telling clients, avoid retail REITs, avoid retail real estate. We're helping existing clients transition to online models and direct-to-consumer strategies. But here's the truth. Traditional physical retail has no viable future for most product categories. Sector number 3. Fossil fuels, specifically coal mining and coal power generation. Economics. Coal is dying not because of environmentalists or regulations. Though those accelerate it, coal is dying because it's becoming economically obsolete. Pure dollars and cents. Renewable energy, wind and solars, now cheaper than coal in most markets. And the cost gap widens every single year. Wind and solar are winning competitive bids against coal, not from subsidies or political favoritism, but because they generate electricity at lower cost per kilowatt, down 80% in a decade and still falling as manufacturing scales and technology improves. Wind turbine costs down 40% and dropping as efficiency increases. Meanwhile, coal faces mounting costs, environmental compliance, transportation, storage, maintaining aging plants. Coal plants need massive capital investments to meet emission standards. With payback periods longer than the plant's useful lives, the economics don't work. Here's the acceleration. Corporate energy purchasing is shifting fast. Google, Amazon, Microsoft, Apple all committing to 100% renewable energy. When your biggest customers demand renewables, coal plants become stranded assets. Utility companies are retiring coal plants ahead of schedule because building new renewable capacity is cheaper than maintaining existing coal infrastructure. We see retirement announcements monthly, and the pace is accelerating as executives realize coal has no economic future. At JP Morgan, we've been reducing coal financing for years. Energy storage, or other businesses that can leverage their existing expertise. But we're direct with them. Coal as an energy source has no long-term economic viability. Sector number 4, traditional cable TV and linear broadcasting. Streaming obviously disrupted this, but you don't understand how fast and complete this collapse is happening. The problem isn't just cord cutting though, that's accelerating. Brutally, the real problem? Younger consumers aren't just leaving cable. They're abandoning television entirely for social media, gaming, and on-demand digital content that doesn't fit the old linear programming model. We finance media companies across all formats at JP Morgan. We see the actual audience and revenue data live. Traditional TV viewership, declining 10 to 15% annually across all ages. For viewers under 35, down over 20% annually. Even worse, time spent watching traditional TV is falling faster than viewership itself, crushing advertising value regardless of audience size. Cable subscriptions are collapsing 5 to 8% annual declines and accelerating as streaming services add content and improve experiences. But here's the killer detail. The subscribers leaving are younger, higher income demographics that advertisers value most. TV advertising revenue is following viewership down with a multiplier effect. Advertisers aren't just shifting budgets proportionally from TV to digital, they're reducing total ad spending because digital gives better targeting, measurement, and ROI than TV ever could. The acceleration factor? Streaming technology has matured on Netflix, Disney+, Amazon Prime proved on demand. Personalized delivery beats linear programming. They're investing billions in original content, often better than traditional TV. But the real threat is social. Platforms TikTok, YouTube, Instagram capturing younger consumers who create and consume content in formats that don't translate to traditional television. These platforms offer interactivity, personalization, and social engagement that linear TV can't match. The business model is broken beyond repair. Linear TV requires enormous fixed costs. Content creation, broadcasting infrastructure, ad sales, operations. These worked with captive audiences and limited competition. Now, with audiences fragmenting across hundreds of digital platforms and ad dollars following, impossible to sustain. At JP Morgan, we've been cutting exposure to traditional media companies dependent on linear TV revenues. We're advising clients, avoid cable companies, traditional broadcasters, TV ad-dependent businesses. We're helping media clients transition to streaming, direct-to-consumer, and digital advertising models. Now here's why all 4 sectors are dying simultaneously and faster than anyone expects. The common thread: technological disruption meets changing consumer behavior, meets economic obsolescence. In every case, new technologies emerged offering superior value for consumers while requiring lower costs for providers. This creates a death spiral. Demand falls. Fixed costs can't shrink fast enough. Competitive disadvantages worsen over time. The acceleration factor making this faster and more complete than past disruptions. Artificial intelligence. AI is automating content creation, optimizing distribution, personalizing experiences, and slashing cost structures of digital alternatives while making traditional models more expensive and less competitive. But the most critical factor is permanent consumer behavior, change not cyclical. Permanent younger consumers aren't experimenting with digital alternatives temporarily. They're permanently adopting digital-first lifestyles that make traditional models irrelevant. As they age and their purchasing power grows, traditional models lose their customer bases completely. At JP Morgan Chase, we're positioning clients and our own investments for this transformation, reducing exposure to obsolete sectors, increasing exposure to technologies and companies replacing them. Not for political reasons, not for environmental virtue signaling, because the economic trends are undeniable and the financial implications are massive. If you're holding investments in any of these four sectors, understand this. You're not facing cyclical headwinds or temporary disruption. You're holding assets. Becoming completely obsolete, the value will approach zero in the next 5 to 10 years. The smart money already knows. They've been reducing exposure for years. The question is, will you recognize what's happening and protect your wealth? Or will you hold on until obsolescence becomes obvious to everyone and value is already destroyed? The choice is yours, but the timeline is shorter than you think. These sectors aren't declining gradually over decades. They're being eliminated rapidly by technologies and business models that are fundamentally superior. The transformation is happening now. It's accelerating faster than most realize. And if you don't act soon, you'll watch your investments evaporate, while others who saw this coming protect and grow their wealth in the sectors of the future.